The founder of the world's biggest crypto exchange just sat down for an hour and said things most people in this space won't say out loud. He admitted one of crypto's fastest growing platforms isn't actually decentralized, even though its own users think it is. He said forcing everyone onto one blockchain, even Bitcoin, is not decentralization, it's authoritarianism. He said AI agents are going to need crypto to pay for things not someday, in a matter of months. And he pushed back hard on Google's claim that quantum computers will crack Bitcoin by 2029 and proposed something wild for what to do with the 1 million Bitcoin nobody's touched in 15 years. Stick around, because by the end of this, you'll understand where the smart money in crypto is actually looking right now. And it's not where you think. Let's start with the obvious question. Is this crash normal or is something different happening? According to the founder, the 4-year cycle is holding almost exactly on schedule. Right now, we've pulled back roughly 50% from the peak, and historically, that's actually mild. Previous cycles have seen 80% retracement. So on a pure numbers basis, this drawdown isn't even the worst one crypto has been through. Even at today's lows, we're still sitting several times higher than the bottom of the last cycle, which came during the FTX collapse. Each cycle's floor keeps rising. The peaks get more dramatic, the crashes look scary, but the baseline keeps climbing over time. And here's something that barely made headlines. Unlike the last two cycles, which were marked by massive blowups, Luna collapsing, FTX imploding, this cycle has had zero major bankruptcies so far. The industry appears to have gotten meaningfully better at managing leverage and risk. So if the cycle shape is the same, what's changed? Everything around it. 4 years ago, the world's most powerful government was actively hostile to crypto, suing projects, driving developers out of the country. Today, that same government is one of the industry's biggest institutional banks. Major asset managers have crypto. Regulatory clarity that didn't exist before is starting to show up. That regulatory freeze out in the last cycle is also why so much of the last bull run's energy went into meme coins. There was no legal path to build anything with real utility, so speculation was the only game in town. That's reversing. There is now real development happening again, more stablecoins launching in more countries, and this is the part worth sitting with, tokenized real-world assets. You can now buy pre-IPO shares of major private companies as tokens on some exchanges. Here's the section you actually pay for. One detail from this interview deserves way more attention than it does. Outside of the US, buying US stocks is often genuinely expensive and restrictive. Opening a brokerage account that can access US markets can require minimums in the thousands of dollars. Money most people in emerging markets simply don't have to do that. On top of that, transaction fees can eat 2 to 5% on trades. And in a lot of countries, it's not even a cost problem. There's simply no access to no matter how much you're willing to pay. Tokenization is being framed as the fix for exactly that gap. Instead of needing a broker, a minimum balance, and the corresponding banking relationship in another country, a tokenized share can theoretically be bought by anyone with a wallet and an internet connection. That doesn't mean it's fully built out or risk-free today, but the direction is worth watching closely if you're in Nigeria and have ever tried to get real exposure to US equities. This is one of the few genuine use cases where crypto infrastructure could remove a real, physical barrier that fiat systems have kept in place for decades. Now here's a moment that should get more attention than it has. One of the standout platforms of this entire cycle, one of the few tokens actually up on the year, is often marketed as decentralized. But when directly asked about it, the Binance founder didn't confirm that. He pointed out that the platform is run by a very small team that retains a lot of control over the system, and he declined to call it truly decentralized. What he did praise is the innovation. The platform found and proved out a market niche that didn't clearly exist before, serving users that regulated exchanges can't touch, largely because it skips identity verification entirely. That's worth sitting with as an investor. A platform can be fast growing and genuinely innovative while still carrying meaningfully different risks than a fully decentralized system its users assume it to be. Decentralized gets used as a marketing word a lot more often than it gets used accurately. Here's the forward-looking thesis that deserves the most attention of anything in this whole conversation. AI agents are increasingly expected to handle real transactions on your behalf, booking things, paying for services, managing small purchases. But today's financial system wasn't built for that. An AI can complete two-factor authentication. It can hold a physical card. It can easily pass identity verification steps designed for humans. Blockchain-based payments, by contrast, are API-driven, machine-friendly by design. The prediction here is that autonomous AI agents will increasingly transact using crypto rails, specifically because the existing card and bank system simply isn't built for non-human users, and this shift is expected within months, not years. One more thread worth closing on: quantum computing. Google has publicized concerns that quantum computers could threaten Bitcoin's encryption as early as 2029. The pushback here is worth noting. Quantum-resistant encryption already exists conceptually. The real challenge is coordinating an upgrade across a fully decentralized network with no central authority to enforce it. And there's healthy skepticism about the 2029 timeline itself. The actual researcher behind Google's estimate reportedly put the real probability closer to 10% by that date, a very different number than the headline suggests. There's also an unresolved question about the roughly 1 million Bitcoin believed to belong to Bitcoin's anonymous creator, untouched since the network launched. One proposal floated: give those coins a fixed window, 6 to 12 months, and if they haven't moved by the time a post-quantum upgrade happens, freeze them out of circulation entirely, rather than leave them as an eventual prize for whoever cracks quantum encryption first. And to close the loop on everything you just heard: cycles, tokenization, AI, quantum, all of it, here's the one belief that stayed exactly the same since this founder started his exchange back in 2017. Crypto isn't going away. Prices will keep swinging hard in both directions. But the industry itself keeps getting bigger, cycle after cycle, blow up after blow up, hype wave after hype wave.
If any part of this made you think differently about where this industry is actually headed, subscribe. We break down what's really happening in crypto and African investing every week.